Welcome everyone. What a wild week it has truly been. We saw ups and we saw downs, but mainly up, with all of the major indices scoring a green week to kick off Donald Trump's first week as president. With an absolute crazy number of executive orders signed just in his first week, how exactly do we digest the fast pace of this administration? And where do we go next week with inflation, housing, growth, and income data, as well as the FOMC meeting and the Fed's interest rate decision? We all know that a rate cut is unlikely, but the wild card is Donald Trump, and anything could happen. So is this the end of the chaos, or is this just only the beginning? We've got a lot to talk about. Let's roll the tape.
Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks retreated on Friday as the first week of the second Trump era ended, with profit taking and all of the major indices in the red on the day, but investors notched a victory for the week as the president's remarks on tariffs and other policy priorities steered Wall Street into the green. Trump's call at Davos for cuts to US interest rates, oil prices, and taxes lifted market sentiment, and his remarks came as the first wave of corporate earnings underscored a largely strong result. Now, we saw very mixed price action right here. Technology and the bigger names took it on the chin, particularly Nvidia, Apple, Microsoft. However, Meta and Google, on the back of some CapEx news, was up 1%, and they lifted the XLC and helped some of the mega caps. Walmart was also positive for some of the mega cap names. A couple of the banks were very mixed on the back of American Express's earnings today, and AVGO was up 1.84%. All in all, a very mixed day on Friday. Not really much that you can take from this chart. The sector analysis sums it up concisely. Now, the worst performing sector here was XLC, the technology sector, down 1%, and that's why the SPY, the S&P 500 today, was actually down 0.3%. We saw a number of sectors in the red, including energy, discretionary, industrials, and materials. They were all down pretty handily, coming off what was a pretty good week. However, we did see healthcare, financials, real estate, and staples all post green, with XLC, communication services, and utilities gaining 0.91 and 1.02% respectively. Utilities was very, very strong today on the back of a weaker dollar as well as weaker rates. And you could see the trend was rate sensitive stocks did really well. Look at utilities, look at real estate, look at financials, look at healthcare. These are all rate sensitive stocks. They did well. And then we had like cyclicals, stuff like XLK, technology, and discretionary. They didn't do too well because, again, it was profit taking, rotation, and some of the comments we actually did get in the market. And we saw much of the same across the broad market. Mid caps, small caps took it on the chin as well, especially small cap growth down 0.67, the worst performing factor segment here today. However, when you look at value and core across small, mid, and large cap, they actually outperformed their growth counterparts, and even mid cap value actually notching a green day, up 0.04% ever so slightly. Nonetheless, though, very broad market rotation, and it really was just profit taking after we saw a very fantastic week across all of the indices. You could see here that the Nasdaq 100 was up 3.38%, the best performer. The S&P 500 in second place, up 2.85%, and then the RTY and the RSP up about 1.7% each. And you can clearly see in the large cap space, we saw lower lows into Friday from the highs we made, literally just some profit taking, whereas the RSP and the RTY saw a little bit more volatility. We saw buying into midday, we saw selling into the close, and that pertains to all of the market moving parts we saw today. However, net throughout the week, posting all-time highs in the S&P 500, we had a very, very solid day. You love to see this type of price action, particularly early in the year, because they say as goes January, so goes the year. However, let's actually talk about why we actually got this dramatic move, because we did move down in a very material way, particularly in the large cap space, and that did affect the overall market.
And a big part of it had to do with Trump. President Trump has taken a slightly softer stance on China. He came out and said he would rather not impose tariffs on China. Now, I seriously doubt Trump had a change of heart overnight. I think what's happening behind the scenes is that him and Xi are working on a deal, and he's he's voicing this out by saying, I would rather not tariff China, just getting it out to the market that maybe something is going on under the hood that is about to be announced in the next couple of weeks. But he is appearing a little bit softer on China, and the global markets really did like that. China was very green on the back of this news, but we did see mixed price action everywhere else. Now, the semiconductor belt of the market, the Southeast Asia portion right here, was very, very red, and that had to do with some of the earnings we got from Texas Instruments, as well as some of the earnings from Sky Hynix and Nvidia's performance here today. Now, we had very mixed price action too here in Europe. We had winners, we had losers, and then we also had mixed price action here in North America as well as South America. Now, I think the big part why we saw mixed price action here in Europe as well as most of Asia, apart from what Trump said, had to do with the BOJ. The Bank of Japan raised rates. The new policy rate is now 0.5%. They raised rates by another 25 basis points, and that did spur the massive move we saw today in the dollar as well as yield. So there was a lot of moving parts coming from what Trump said at the start of the week, what Trump said today, the Bank of Japan, as well as earnings. There was a lot of earnings today, guys, and it continues what we will see for the rest of the week. Now, American Express, despite turning in solid quarterly results, credit card company fell more than 2% Friday afternoon. Some investors were disappointed by the outlook. American Express posted net income of $2.17 billion compared to $1.93 billion a year ago, logging diluted earnings of $3.04 per share, just ahead of the estimate of $3.03, but the revenue growth forecast between 8 and 10% may have turned some investors off, as some were looking for a range above 11% in the double digits. And that's why American Express was down 2.39%. But I think the management team are just playing it a little bit conservatively. Twilio surged more than 20% today as Wall Street analysts grew increasingly bullish on its artificial intelligence potential. Analysts anticipate improved profitability through the company's expanding generative AI capabilities, including conversational AI technologies. Fourth quarter results projected revenue of about 11%, surpassing analysts' expectations of 8%, hence why the stock was up. And then Meta. Shares of Meta rose 1% on Friday after CEO Mark Zuckerberg announced the company plans to pour billions of dollars, the exact number is $65 billion, into its artificial intelligence development efforts. They're going to do $65 billion worth of CapEx to really boost AI demand. They were up 1.4%. Google was up as well. And AI CapEx will continue to be very strong in 2025. Now, other market movers here today was actually some economic data. Very interesting data we got. I think the big thing the market was looking at was actually manufacturing PMIs, essentially goods manufacturing, which has somewhat been in a recession for the better part of the last 18 to 24 months, right? The consensus expectation was for 49.7, a contraction. Anything below 50 is a contraction when it comes to PMI manufacturing data. Above 50 is actually an expansion. We got 50.1. We beat analysts' expectations. And I think that was part of the reason why we actually did see like the broader market do really, really well. And then we saw the composite PMI come in at 52.4. However, a little weaker than expected because services came in a little bit weaker than expected. However, looking at existing home sales, 4.24 million versus the consensus 4.19 million. So we actually beat expectation by a wide margin there. And then we actually got existing home sales month over month grew 2.2% versus the 0.3%. So housing data absolutely smashed expectations despite higher rates. And then we also did see consumer sentiment come in below expectations as well. So very mixed economic data, but I think very positive signs with the housing data we're seeing, as well as manufacturing goods turning the quarter. Even though we did miss here on the services segment, that is an expansion compared to the year prior. And you love to see that type of data. And all in all, guys, and for everything we saw today, we actually did see more stocks advance than decline, despite the red we did see, but that's because a lot of the bigger names actually posted red results. However, market breadth continued to improve and market momentum remains very, very solid. In a bull market, you don't stay down for very long. And yeah, shorter term averages looking really, really good. Longer term averages looking really great as well. This is the type of stuff you want to see. We probably will go ahead and recapture the 50-day moving average sometime next week. And yeah, huge improvement in breadth in the last month or so. And this is the type of stuff you want to see taking us to all-time highs. Now, looking at the chart, it was a very ugly day for equities as a whole. The S&P 500, the Nasdaq 100 all came off their highs. So too did the IWM. We're looking a little bit red here in the extended hours. Mid-caps were actually the best performing sector, down 0.08%. The RSP was largely flat. So, the broader market did outperform relatively speaking, but the S&P 500 was down, the Nasdaq 100 is down, and that weighed on the overall market just because of the weight of these large cap names. However, we did see positive developments here in the dollar. The dollar fell 0.6% and yields as a result fell. And that had to do with some of the stuff we saw with the Bank of Japan as well as Trump. Dollar falling, yields pulling back as well. And as a result, bonds gained. Because of a weaker dollar, we also saw metals gained as well. Gold and silver gained 0.6%. Bitcoin was up 1.37%. WTI gained ever so slightly. Nat gas fell 1%. And all in all, guys, what I said yesterday is playing out in the S&P 500. I said we are at the top end of the range here in the core resistance, and that means we probably will see downside. That's exactly what we saw to cap off the week. We saw a bit of downside, a bit of profit taking. We saw that in the Nasdaq 100 as well. We saw a little bit of a pullback as well as the RTY. So we did see a pullback here off the core resistance. All we need to see now is a move up in these levels, the core resistance. If the core resistance can move up, this will give us upside to move into next week. However, a lot of next week is going to be dependent on earnings and data. And at the end of the video, I talk about what to expect for earnings and what to expect for data next week. So go ahead, skip to about the 20-minute mark in this video, and you will see me talk about that respectively. Nonetheless, guys, what we really saw today was just a technical move spurred on by some of the earnings, the macro, the fundamental, and some of the political. All of that coming together today, everything, and all of that coming together for us to just see a little bit of a pullback. The market saying, hey, I just want to take some profits after seeing anywhere from 2 to 4% gains in the major indices. And to be honest, it's very, very healthy. Now, what do I expect going into next week? I think that we should continue to see a little bit more of momentum to the downside until we actually get the core resistance moving up. Once the core resistance move up, that may be on Tuesday and Wednesday, it may be Monday. That's when we could start look at getting a little bit longer in this market. Nonetheless, do expect downside until the core resistance moves up. I'm not saying we're going to crash, okay? I'm just saying we're probably going to pull back maybe 0.5% or thereabouts. But you can't deny the fact that we actually had a weekly close at all-time highs, and things are looking very, very solid for the S&P 500. That's another weekly all-time closing high in the context of the S&P 500 just making higher highs, higher lows, and new all-time highs. Very, very solid. The weekly chart looks really, really good. You look at this and it's just bullish. There's no two ways around it. We are bullish. You're in a bull market. You want to buy any pullbacks that we do get because stocks don't stay down for very long. I mean, the longest time period we were actually down was 3 weekly candles right here. 3 weeks. On the 4th week, we put in a very bullish candle and continued onward and upward. We saw quite a bit of churn right here. 1, 2, 3, 4, 5. 5 weeks of churn, a very bullish engulfing candle. And now we continue to move onward and upward. Nonetheless, guys, when we look at the daily chart, we should see a little bit of weakness to start the week. Once the core resistance moves up in the S&P 500, then we can continue to move higher. And the same is true with the Nasdaq 100. Same thing. Expect a little bit of volatility here. That's exactly what I said yesterday. And then when the core resistance moves higher, we can then put in a low and continue to move higher. But that's all dependent on earnings next week. We have the big names, Apple, Meta, Google, Microsoft. They're all reporting next week, and that's really going to move the equity indices. I think earnings is going to be great. So far, earnings season has got off to a really good start, but earnings is really going to determine where the Nasdaq 100 goes, but not necessarily the RSP. I think the RSP is going to continue to move higher into next week. Again, we're going to see a little bit of weakness, put in a bottom, and then I think we're going to continue to move onward and upward. So do expect a little bit of weakness early on in the week. And if we get the earnings and data that's supportive of the market moving higher, we will move higher in all of these indices. And the same is true for the RTY. Earnings looking really good. Expect a little bit more weakness. Now, the RTY is volatile. It could get as low as the gamma flip. You want to buy the gamma flip irrespective of what happens. And then when the core resistance moves up, wherever we are, buy those longs and then move up from there. As long as we break this level next week and have a close above, it opens up a lot of these higher levels, including the 52-week highs and all-time highs for the Russell 2000. Now, in terms of individual stocks that I really do like, guys, I'm really still liking PayPal. I'm still in this name. I'm still holding. And
what we're really seeing with PayPal right now is sort of just like the stock is spacing out, digesting the 60% gains we've had in about 3 months. So we're just going to continue to digest. And I think the next catalyst is going to be earnings. Another name that I like, Paycom, looking a little bit cheaper now. My fair value is about 220, sitting at 207. It got a bit extended right here at the 240 level. It's come down. And again, like PayPal, we're sort of just basing out right here. We're going to wait for earnings to make the next move to the upside or the downside. I think you remain constructively bullish on Paycom as a whole. Another stock I've been buying a lot lately is Evolution. Now, this stock is a turnaround play. They were up about 2.6% year to date. You are betting on a turnaround right here. So keep this position size relatively small. And then in the mega caps, I genuinely do just like Google. Google is a very solid name, the cheapest of the mega caps. And you can see we were forming like pennant here. He broke above, and now we probably continue to move higher. Fair value for Google is somewhere around the 210, 215 mark. And I think going into earnings, that will be the next catalyst. Nonetheless, I think if we do get to like the 184 level here on earnings, you buy that because Google is well positioned for the next decade, continue to grow their earnings very robustly, especially with AI and everything in between. All in all, those are the individual names I like. In terms of ETFs, you guys know I like the Moat ETF. Another ETF I like is QSML, particularly on the ASX. If we actually look at a year-to-date chart, right, and on a percentage return basis, this is up 4.85%. Very, very strong year-to-date returns. Very strong one-year returns, 21%. And yeah, look, it was very, very volatile, but solid one-year returns. I think it beat the S&P 500 in returns last year. Now, it doesn't really show this, right? But this is 21% return in the last year. And this also pays about a 4% dividend. So you're looking at about 25% returns in the last year. Very, very solid returns. So I like QSML, quality small caps. I like QUAL. This is the quality ETF, large caps. I like both these ETFs. I like the Moat ETF as well. No, I also just do like the S&P 500, the NASDAQ 100. I like the RSP and the S&P 600, S&P 400 as well. So these are where you want to be positioned, where you want a dollar cost average. If you're looking for individual names, you guys know the names I like. And all I can say is right now, guys, any opportunity for a dip like we got right here, and like we got right here, continue to buy that dip because things looking very, very constructive for equities, for the economy, for the market, and for the future. So buy the dip.
And guys, diving into sentiment, what we've seen in the fear and greed index in the last couple of weeks is we've seen quite a move from where we were here in the fear zone. We just teetered on extreme fear. We were mostly in between fear and extreme fear, and we have now actually seen a push up into the neutral zone. I've been saying this for many, many months, guys. The entire time the fear and greed index was in this fear, extreme fear zone, I said you want to be adding, you want to be deploying some capital. And to those that have the S&P 500, the NASDAQ 100, and even small caps, the Russell 2000 has rallied as a result. And this is where we are right now in neutral territory. And if history is anything to go by, if this momentum continues, we should see a move into the greed zone and potentially into the extreme greed zone. So for those of you that are long, it's very, very simple what you need to do. That is simply hold the line. Because when you look at indicators like this, we could see a lot of bullish momentum in 2025. We had 57 all-time highs, record highs in the S&P 500 in 2024. In 2025, we have had only one. We could see plenty more, because the average year sees 19.3 all-time highs in the S&P 500. So what does that mean? It probably means we go higher from here. And the truth of the matter is, across the board, the fundamentals back up the price action we're seeing. Look at the Russell 2000 right now, guys. If you look at revenue, right, 1.6% revenue growth, 3.2% if you exclude energy. And then you look at what these figures translate into earnings. You're looking at a nominal 48.2% earnings growth in the Russell 2000, 78.2% if you exclude energy. And energy is a little bit of a dumpster fire, 47% earnings decline. But yeah, we really need to look at the Russell without this sector because this is really an anomaly. So we're seeing very, very good earnings here in the Russell 2000. Margins at 3.3%. I don't have the individual sectors for margins, but margins are looking a little bit stronger than what they did last year. All in all, earnings looking really, really good right now. And of the 118 companies that have reported,
71% have reported above analyst expectations. Very, very strong earnings. And the same is true for the S&P 500. The beat is not quite as big. However, we are seeing 10.7% earnings growth. This compares to the 9.6% estimate at the start of earnings season. Revenue looking very, very solid, in line at the moment. Margins are 12.8%. And we are seeing 81% of S&P 500 companies are beating analyst expectations, with the big sectors, financials, comm services, tech, discretionary, and healthcare all reporting double-digit earnings growth. You love to see that. And at the end of the day, guys, this is what's really going to drive the market in 2025. Earnings growth. It's not going to be multiple expansion. It's not going to be any other sentiment figure. It's simply going to be the fundamentals and earnings, as well as rate cuts. Rate cuts are a big determinant for where equities go. And if we look at the historical backdrop, the US equity performance right now is actually in line with non-recessionary cutting cycles. You can see this is us, the dark blue line. And pretty much if the Fed cuts rates and we have a recession, this red line is what we get. And in every other instance, it's this green line right here. So when the Fed cuts rates and there's no recession, what we normally see 2 months on is about a 50% return in the S&P 500. We're following that exactly as is right now. So all in all, guys, we should expect higher price action. This bull market will continue. And from what it looks like right here, we should probably expect sideways momentum that actually aligns with what we normally see in a post-election cycle. We normally see sideways momentum into like April, May. That probably coincides with this point around here. And then we actually see a movement onward and upward 12 months, 24 months on. But this cycle has been very, very weird when it comes to the rates market. Normally what actually happens when the Fed cuts rates is we see the 10-year yield move lower, then sideways, then continue to move lower. In our case, we actually haven't seen that. The 10-year yield has actually risen about 100 basis points since 100 basis points worth of cuts in the Fed funds. So why exactly did this happen? Well, it's very, very simple. It has to do with the macro picture. You see, when the Fed cut rates and then we got that December economic projections, what we really got was a growth upgrade along with a hawkish policy shock, and the market expectations recalibrated to reflect stronger economic data and a stronger economic outlook, and that resulted in yields moving up. It was actually a positive. The problem is the market took it as a negative because higher yields is simply stronger competition for stocks. But I do believe we are actually going to see inflation tick down, and we are going to see the Fed cut rates more than 2 times in 2024, and that's because of shelter inflation. CoreLogic single family rent index came in at a 14-year low today. Family rent growth slowed to 1.5% year over year in 2024. We are about to see a big shelter disinflation impulse ahead, and we might even see deflation. And this is something I've been ringing the bell on a lot, because if you actually look at the consumer price index rent, essentially what the CPI uses to calculate rent, they call it OER, owner's equivalent rent. Then you look at something like the Zillow rent index, the BLS all tenant index, and the CoreLogic single family rent index. They all moved down in a material way well before the CPI rent did move lower. And now the lagged effects of OER of the CPI rent index was about to make its way into deflation. And we are also starting to see that rents. Guys, look at stuff like Denver, Austin, San Antonio, Salt Lake City. We are seeing rent deflation across the board. Yes, some instances of rent inflation, don't get me wrong, but still measly when compared to history, and deflation nonetheless. And this is what is going to give the Fed the power to cut rates even more. And to be honest, because of this, we may even see a growth scare in the middle of the year pertaining to the overall inflation picture. However, as long as GDP and growth remains robust, which it is right now, Q4 tracking for 3% GDP according to the Fed's GDP now, as long as growth remains robust, disinflation or a rent disinflation impulse should actually be a positive thing net. This is also on the back of incoming liquidity. The Treasury General Account is about to be unloaded into the market. This is going to be a huge liquidity boon simply because the government needs to sort out the debt ceiling. This was the previous debt ceiling negotiations. This was it right here. And what we normally see is a drawdown of Treasury General Account to fund the economy for the next couple of weeks or months. So when you have stronger growth, disinflation, and liquidity via the TGA being drawn down, because of debt negotiations that all bode really, really well for stocks to go higher and the macro environment to be favorable for 2025. Now, looking at data next week, guys. So we kick data off on Monday. We have home sales, month over month, year over year data. The expectation there is 0.64 million and negative 3.5% growth in home sales. And on Tuesday, we get durable goods. And on Wednesday next week, guys, we get the FOMC, the Fed interest rate decision. The consensus is for it to stay at 4.5%, so no cut. We also get the press conference. Then we get the Q4, the preliminary figure, GDP quarter over quarter. It's the advance rate. Right now, looking at the forecast is 3%. Fed GDP now is at 3%. And then we also get PCE, so a huge week of data. We get growth markers. We get inflation markers. We get consumer markers. We get housing data. We get the Fed interest rate decision, guys. And that is on the back of what's going to be a crazy week for earnings. This upcoming week, we have all of the big names. We have Apple reporting, Microsoft, Amazon, Meta, Tesla, Visa, MasterCard, ExxonMobil, AbbVie, Chevron, T-Mobile is reporting as well. ServiceNow, Blackstone, TMO, Thermo Fisher, IBM, Baba, Caterpillar, all of these big names, high impact names, these market moving and sector moving names are reporting next week. Coupled with the data we're about to drop, be prepared for one thing, and that is volatility. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.